the distance throw you off. I work closely with Weston on his investment team, digging into asset allocation, markets, positioning, and working with our chief investment officer, Tim Holland. Hopefully, you have had a chance to see Tim speak. If not, I'm sure you will soon. So his name is on this deck here, and it's really hot off the presses. So if I skip ahead or skip through a section, it's because it's really fresh off the press here. So, but today we're going to talk a lot about markets from a Wall Street and a Main Street perspective. But I know everybody in the room has a real estate focus. So as Weston mentioned, I'm going to carve out a specific 10-minute section at the end to make sure we hit on those subjects, and then some Q&A to make sure as well. Weston, anything else before I dig in here into the content?
I don't think so, Derek. Anything you'd like us to share before we dive in? Are we good?
Nope, just jump in. If they have questions, we'll ask them. If I have questions, we'll ask. So.
Okay, Ryan, I'm
All
going to
right.
let you take over, and I'll be here to pitch in as needed.
All right, let's give it a go. So hopefully everybody can see the screen very well, but you see the title here, Party Like It's 1999 or maybe 1997. That's a lighthearted way of saying that we're really optimistic on the outlook for Wall Street and the stock market in 2025, probably more than most, certainly more than the average analyst out there or economist. That's not to say that the economy isn't going to go bad or sideways as well, but we're even more so leaning into the stock market. And we'll get into how that ties into the real estate market as well. But you see the subline here. We're also going to touch on some things called animal spirits, which are hard to tie down and define. And then we're also going to dig into the implications of Trump's second term. And then if we go to the next slide here, let me make sure this works first before I. There we go. Okay. So just breaking this out into sections, we're going to review the past year in 2024 and why it was so good for stocks and equities and the economy. We're going to talk very briefly about the rest of the world on the international markets. As I mentioned, animal spirits, we'll get into what that means. We'll get into Trump's second term. And then the 90s, there's a lot of correlations and similarities between that decade, which is a very, very exciting time period for Americans and businesses alike. So we'll touch on why we think there's some really nice similarities that line up well with today's environment. And then lastly, can the bull market continue to run here? So a lot of folks have been asking us, can this run continue? We'll tell you why we're leaning into yes on that answer. But to start and kick off here, looking back at 2024, it was really a banner year for stocks. So the S&P 500, the headline U.S. stock market index, finished the year close to 25% higher. And that comes after another 20% gain in 2023. So that was the first time that has happened since 1998, where you got back-to-back 20% moves for stocks. So a really nice year. And tech stocks did even better. In the NASDAQ, that was up closer to 30%. And really the reasons that kind of underpinned that momentum and optimism that carried stocks higher was really a trifecta for Wall Street in terms of getting interest rate cuts and clarity from the Federal Reserve. You had Trump's win in November, and then you also had corporate profits almost double from the year prior. So you really had a nice tailwind that set up a great run in 2024, and there's no reason that can't continue in 2025 as well. I touched on tech stocks briefly. On the left chart here, you can see the quote-unquote magnificent seven big tech names, starting with NVIDIA and down to Microsoft. Most of those names outperformed the 25% return for the S&P 500. The Russell 2000, which captures small cap equities, has been really choppy of late. And if you see that high line on the chart, this is just the second half of the year, but the high line, it notched almost a 20% gain before giving some of that back to finish off November. And we'll get into why small caps might do well as well. Volatility was historically light, so we had very, very, very few choppy days where the market was whipsawing back and forth. The end of December and the first week of January, we saw a little bit more volatility, but it was a historically light year for volatility as well, especially in an election year, which tends to coincide with a lot more choppiness as uncertainty presents itself. Bonds, on the other hand, struggled a bit. So the Bloomberg U.S. Aggregate Bond Index is the headline capture of your traditional corporate and government fixed income securities. It started the first half of the year negative territory, clawed back as it looked like the Fed was going to cut rates. And then once they did cut rates, the ag actually moved lower and long dated yields moved higher. So we'll get into why that dynamic played out as well. But the ag only finished up a mere 1%, which pales in comparison to stocks. Now, it's not supposed to keep up with stocks, but you do expect to get certainly more than 1% return for a calendar year.
Ryan, one thing I want to throw in on that as well, because this is something a lot of our real estate clients are using. Bonds are kind of a really good place to land money when you're in between real estate deals because of the low volatility and the lower risk. In the way we like to do bonds and buying them directly instead of an index like this, returns were much better. Many of our clients were returning closer to that 4, 5, 6% range, depending on when they bought them and all of that. But when you own bonds directly, you're taking a little bit out of this index because you're in control of the returns a lot more.
Sure, that's a great point, Weston. And if you look at the makeup of what's in the ag, it's really probably 1/3 government securities like treasuries, 1/3 corporate treasuries, or I'm sorry, corporate bonds that have a maturity profile of investment grade, and then probably 1/3 a mixed bag of intermediate term securities. So it's not a perfect way to capture the whole bond market, but it's the best we can point to. And to your point on the real estate side of things, cash has offered a really nice yield of late. So while you are in between and have to hold that, you are getting a decent yield compared to years prior. So I'd say that's probably a bright spot within the fixed income asset class as well.
Yeah.
So just moving on here and a look back in 2024 still, we never got a recession. So if we held this call in January of 2023 or January of 2024, I think a lot of us, ourselves included, would have said the odds of a recession are pretty 50-50. And the reason for that is that the inflation run up that we had and the Fed tightening with interest rates, we all kind of thought that those impacts would eventually surface in the form of consumer strain, bankruptcies, credit defaults, and other things that you traditionally see with recessions. And that did not play out as well. So another notch in the tailwind there as the economy held up better than we thought it did or thought it would. You see the unemployment rate there. It's ticked up ever so slightly over the past couple of years since a low of 2022. But an unemployment level of near 4% is just not going to bring you a recession. So the jobs market really held in there. And we continue to see strength in more recent reports as well. The S&P 500 corporate earnings that I mentioned, a great tailwind there. Corporate profits, I think, finished the year 7% higher compared to where they were the year before in 2023. And looking up to 2025, analysts on Wall Street are projecting anywhere from 10 to 15% corporate profit growth. So it's lining up for another positive year in 2025 for profits. As I mentioned, the U.S. consumer hung in there. It wasn't great, and it's certainly probably a K-shaped dynamic where you have folks who own assets, benefiting from the inflation run-up of the past 4 or 5 years. Whereas if you don't own assets, you're really taking the brunt of the inflation headwind, really personally, and probably struggling to pay your rent, probably racking up credit card debt, probably borrowing more than you have to, and that's starting to surface a little bit. But the big takeaway here is that the dam never broke, and part of that is because wages have accelerated quite a bit too. So yes, you're seeing those inflated prices. Yes, you're seeing those headwinds, but folks are bringing home more in their paychecks to account for that. But you see the right consumer loan delinquency rates have ticked up since 2021. But if you look further back in the 90s and 2000s, you can see that 2008 global financial crisis, they're well higher than they are at present levels. So that just kind of speaks to the resiliency of folks doing better than we think. Part of that is the gig economy that's emerged where folks are doing DoorDash and Ubers on the side and things like that to close the gap that didn't exist of yesteryear. put the housing market home price index in there as well. And that's another big reason that the economy and spending is doing better than we thought. We haven't had a correction there. People have a lot of equity in their homes. People have low rates that they're locked into, or even no mortgage whatsoever. So those folks are doing the heavy lifting when it comes to spending and aggregate data that you see tied to the consumer. Fed Chairman Jerome Powell had a big rate cut announcement in September. And if you look on the left, the Fed funds rate is kind of the prime borrowing rate for big banks, and that rate filters down everywhere past it into other maturities, other tranches, and consumer loans, mortgages, you name it. It's all tied to that. There's a current bit of a dislocation there, and we'll explain why. But you see that big steep run up in interest rates that the Fed set to combat inflation. It went sideways for a bit in 2023 and 2024, and you finally got that first kickoff cut back in September of 2024. And since that move in the fourth quarter, stocks have moved higher on the news. So all in all, 2024 was a very good year for the stock market. The economy did better than we thought, and Americans hung in there with their checkbooks at home. So I'm going to skip past this section in bulk, but I will make a couple comments here that ex-US markets have been really depressed over the past decade or so. And 2024, I think, was really the perfect storm of just bad news. So if we had a lot of good news in the US, we had a lot of bad news overseas, whether it be the predicted tariffs that Trump is going to implement on day one of his second term. You had a lot of political election chaos outside of our borders in Mexico, in France, in Germany, in Japan, etc. You have the geopolitical dynamic that is a little bit closer to home for Europe, going on with Russia and Ukraine. And then you have more sensitivity to China's market, which has just been in a growth rut since COVID-19 pandemic. So a lot more going on overseas that hurts ex-US companies than at home. So again, I'm gonna skip through this in the interest of time, because I want to make sure that the comments are targeted for you guys, and I think we can move past this if that's okay, Weston. All right, he's nodding.
So past this one.
I got the all clear. All right. So animal spirits. What the heck do I mean by animal spirits? Animal spirits are simply undefined, optimistic, broad sentiment that exists that you can't really measure all that well. And we take a stab at measuring it. But the term really originated from an economist of yesteryear that's kind of antiquated at this point, but at the time he was pretty prominent, John Maynard Keynes. And he first penned it in one of his authored books, where he was describing that he cannot mathematically compute why people are feeling so optimistic and so spontaneously positive when there's no reason to. So he penned that in his book, and that's kind of where it came from. Other economists and market prognosticators have used the term loosely as well. So if you hear it in the headlines, that's all we're referring to. And why we say that is because Trump's victory in November really sparked a wave of undefined optimism, whether it be the hard to count votes that surfaced in the election. And again, I'm not trying to get political here, regardless of what side of the aisle you stand on. But it simply kicked off a wave of optimism in business and in Wall Street in particular. And that's really what our focus is, right? We don't necessarily care about some of the social issues, the cultural issues, some of the amendments. We really care about corporate profit health, Americans doing well, spending money, and growing the economy. That's really what our focus here and what we're paid to do. So capturing that optimism, you can see on the left, small business surveys just implicated a massive spike that really played out in 2016 as well, when Trump won back then. And then consumer sentiment has ticked higher as well. But this enthusiasm is also contagious. If you look at the number of bears surveyed versus bulls on Wall Street, there's more bulls than bears now, and that tick up really kicked in November. You see some of the headlines that back this kind of mysterious, hard to define runs, things like Bitcoin running higher, 57 all-time highs in 2024. Economists capturing the sentiment as well, and it's nothing more than that. That's all we're trying to say. So there's this kind of underlying pep in people's steps that are kicking in and starting to surface in the sentiment around Wall Street. So that's all we're trying to say there. if you dig into the Trump policy specifically and what we can expect in his second term, the first thing we need to do is acknowledge that Republicans do control all three branches of government in the executive and legislative, both sides of Pennsylvania Avenue. The hard to define one here is the House of Representatives. So since this graphic was built, there have been a couple, I think, cabinet appropriations, a couple resignations, and that margin is down to like just a seat or two. So that could change in a special election or two. But for now, they hold a very, very slim majority in the House, and that gives them all three chambers of a majority there. And when we do have that set up, returns are still above average compared to some of the more bearish setups that you can have for historical stock returns. So this is a decent setup. It's not the best, but it's still very good and above average. And then getting into Trump's policy specifically and what we're expecting, it's a big thing around deregulation, taxes, and just pro-growth business policy here that we're really focused on. Some of the question marks that we have are what the impact of immigration is going to have and what the impact of tariffs are going to have. I think both are going to contribute inflation and make the Federal Reserve's job a little bit harder than had Trump and the Republicans not been as loud as they have been on some of these things. I think Wall Street was expecting maybe some watered down comments that translated from the campaign trail into the White House. And, it seems that Trump and Republicans are doubling down that tone. So we'll see just how bad they are and how steep they are. I think the tariffs are going to be like 60% on China, I think 25% on Mexico, and then 10% potentially elsewhere. He might use some of that as leverage in negotiations to try to make some deals, which he loves to do. But the hard part is he's a little bit hamstrung by just our government budget and deficit in DC. So, spending uncontrollably will not go over well just because we've been in a long-term trend of doing that already across both sides of the aisle. So if he's going to make some big cuts there, some of that is up to his discretion, but some of it you can see in that pie chart, 61% of the budget is mandatory. It's written in law that some of that spending cannot be wiped out. So I think you've seen Musk in the DOGE quote, if you will, call out 2 billion or maybe it was trillion areas of government that can at least be improved or cut. That would fall into that discretionary 26% pie. So we can really only target that 26% of the pie that can be impacted. The rest is either interest or just mandatory spending, unfortunately. So like I said, deregulation and taxes are a big deal. The 2017 tax cuts that were passed in the first Trump administration are set to expire at the end of 2025. So if nothing is done in Congress, those will revert back, I think, to 2016 levels and structure. So I think there's a big push, and that's going to be in his first year to get something done on extending those taxes. And then just general deregulation, we can confidently predict that will probably play out. Things like increased drilling rights for energy. You saw some news around, the big data center carve out for real estate that would impact you guys as well on the commercial side. You see things like banking regulations being stripped down to make banks a little bit more competitive and profitable. Industrials looking across the border and making their prices more competitive. But if you look on the first day after Trump was elected, this is just a one-day snapshot. I think it gives you a great preview as to where certain sectors are headed. Financials being the biggest one that we're circling with some of the bank deregulations there. Industrials I mentioned. Down at the bottom, you'll see real estate minus 2.6%, and that might jump out off the page, probably more glaring than it is. But part of that is just because of the inflationary nature of some of the things I mentioned with tariffs and immigration. That inflation would challenge real estate, but it would also challenge the interest rate narrative. So if the Fed has to keep rates elevated and higher, that would be a headwind for real estate. So there's more going on than just meets the eye there, but this is a nice snapshot in terms of what to expect from a sector perspective. I mentioned the debt already. That kind of transcends Trump and both parties here, but we have to do something about it. We've been able to kick the can down the road indefinitely. Whether that rears its head in more pronounced fashion is remained to be seen, but it's certainly a headwind. I don't think I have time, Weston, to cover all of these bullet points here, so I'll just let you guys skim through that briefly. Some other winners and losers, and acknowledging the Elon Musk X factors as what the market could be telling us. But regardless, stocks usually fare well post-election. So down there at the bottom, you can see the average 3 and 6 month gain after a presidential election is 2% and 8% respectively. And we're certainly somewhere in between that today as we enter 2025. And then the first year of the presidential cycle is historically good for stocks as well. In the 90s, I want to spend some time on that, and then we'll move it right over to the real estate discussion if we have time, or we'll make sure we have time. But if you look back at the 90s, there's some things that are almost identical to where we see today in 2025. We had a recession in the early 90s, and then the Fed raised rates. You saw a more benign easing schedule from the Federal Reserve. Productivity surged. You had the dawn of the internet. You had a huge tailwind in IPOs, M&A activity, retail trading, cash coming off of the sideline. And all of that kind of speaks to similarities that we see today in 2025. If you look at that Fed funds rate, it's almost identical to what we see in the past couple of years. So, if the Fed holds true to their word and they are going to cut rates over the next few years, and the economy is in good shape, again, that sets up for a really nice tailwind. And just because we had 2 years of 20% plus in the past couple of years doesn't mean that can continue or can't continue for several years beyond. So 95 through 99, you saw just great returns year after year. So that just because we had 2 great years doesn't mean you can't have a nice run like you saw back in the 90s. I mentioned some of the things that we see today. Your NVIDIA is kind of similar to a Cisco or AOL back in the 90s. We call it the Federal Reserve and what they're guiding. We call it relatively attractive valuations. The soft landing for the economy. So it's all there, and you could paint that picture again in the next few years. Another big reason we think that can continue is because there are a lot of red flags that are not being checked right now. So if you look at that column on the right, we list out signals to keep an eye on to see if the market is really getting frothy and we could have a bubble pop. So if you just run down the list there, most of those are not really checked off. I think the one big one that we do need to acknowledge is that valuations are high, but they're really concentrated in the tech segment of the economy. We haven't yet seen a big widening or breadth expansion to other parts of the economy that would kind of confirm that things are almost way too optimistic, or that exuberance that you worry about towards the top. So if you just run down that list real quick, I'll let you guys do it on your own, but you can kind of see that most of these things are in benign territory in 2025, and that gives us hope that we can keep it going.
It looks like Derek has this recorded as well. I assume he's going to send this out to everybody. So if you need to come back and revisit some of these slides, or like Derek said, if you have questions, reach out to us. We can go in further depth with people.
Yeah, this is all recorded, so everyone that's attending will get the link once it's live.
Exactly. We'll have the slides available for sure. I made some of these comments already, but the PE ratio is not where we were in the 90s. It's elevated. You have some things to worry about, whether it be some slippage in home prices. You have some geopolitical concerns. You have maybe overly optimistic optimism for AI. So there are some things that could certainly trip us up, but we certainly don't see a lot of those red flags being checked. I'm going to skip through this if that's okay, Weston. And I'll finish with this segment here before we pivot to real estate. Most bull markets run a lot longer than bear markets. And if you look at this slide dating back to World War II, I believe, you can see those orange or shaded red areas that dip below are the bear markets, and the blue areas are the bull markets. And aside from the scale here and how much higher bull markets tend to run, if you look on the x-axis laterally from left to right, you can see the length of time that the bull markets run are pretty long, and a lot longer than bear markets. And if you fast forward to today's environment for the past couple of years, we're historically probably only about halfway through what the average length of a bull market tends to last for. So we think the party can continue. We see a lot of similarities to the 90s. Yes, we acknowledge some headwinds, some risks, but there's certainly a lot more positives than negatives, the way that we see things playing out. Again, we avoided recession. The consumer's hanging in there. Things are headed in the right direction on rates and guidance there. So you add it all up, and we're optimistic for Wall Street. So let me pause there and see if there's any questions before I pivot to the real estate segment. You might be wondering why there's no dedicated slides here, and that's not a slant or anything like that. We just didn't have any prepared remarks in this structured deck that tied to real estate, so I'm going to make those verbally. But I just wanted to pause real quick and see if there's any comments pertaining to what I just walked through first.
Just to surmise, what are the two things that have got you most excited about the economy? What are the two things that scare the crap out of you?
It's a great question. I think the positives on the economy are that lack of recession era risk in credit spreads. So what I mean by that is if you get some spookiness in the bond market where you see defaults and credit card debt not being paid back, foreclosures, et cetera, then you start to sound the alarms and say that you could have some problems looming. But the yield that you're getting paid to take on a very risky junk bond or risky loan is not much more than you're getting paid to buy a treasury, and that just instills confidence that the underlying fundamentals are at bay. And I think that's a great reason to have confidence that the economy can persist higher for an extended period of time. And that certainly translates to some of the surprises that we've seen in consumers doing better than expected, in folks being able to weather inflation, banks not going under. You saw the Silicon Valley Bank example where we weathered that storm, where it seemed like you could have some contagion effects there. So all in all, you're getting a lot of positive surprises, and that tells me that instills confidence in that call. In terms of things that worry me, it's not a catastrophic worry, but I do worry about longer dated yields running in the wrong direction, counter to what the Fed is guiding. So that they cut twice. I'm sorry, they cut in September, and then they had two smaller rate cuts to close out 2024. But you've seen the 10-year and the 30-year Treasury yield run higher. You've seen mortgage rates run higher, and that's just the market communicating that we're not fully done on the inflation battle, and we're not quite to the 2% threshold that the Fed wants and is historically good. So those are markets saying that we're not quite there yet with you, Jerome Powell, on your rate cut plan. So that gives me pause that we could have some choppiness and some headwinds that might struggle to get inflation down further. Some of those things are just flat out of the control of the Fed. For example, the Federal Reserve cannot build more houses to dampen the price run up in prices for housing. And shelter is a big cost in inflation and headline CPI numbers. So you're seeing frustration in some parts of the FOMC, who is the governing body that influences Powell. You're seeing some frustration there because those things are out of their control. So they can control rates, they can control how much money is coming in and out of the economy, but they can't force a home builder to build a house and ease the inflation burden on buyers there. So that gives me pause. I think some of the rhetoric with China and what could come if we ramp up the trade war. You saw things hit a rut in 2017, 2018 as China retaliated in the first time around. It seems like there's a bit more hostility and potential for more pronounced responses in China's economy. So that gives me pause as well. If they decide to invade Taiwan or Putin goes off the rails and does something crazy, that gives me pause as well. But putting a percentage on that is almost wasted breath. And in terms of how you manage your money, I think the status quo that we have now is probably the best bet for that. But I'm not blind to those scenarios.
Ryan, just a question that came into the chat as well, and I'll get your opinion on this, and I can pitch mine as well. How does Utah compare to these national projections of the economy?
Even better or on par. So, and I was going to carve out a few comments on Utah real estate, so I'll just go ahead and do that now and work in the question. But unemployment in Utah is lower than the national average, and that's impressive considering the national average is only at 4% or 4.1% unemployment. So Utah being even better than that is just an accolade to be proud of. I think the Utah real estate market has a lot of things going for it, and the longer term trends that predated COVID-19 are going to continue. So I think I think the high price West Coast cities and affluent areas are going to be harder to achieve growth in the West Coast, and I think you've seen that tailwind play out in Utah, where people have moved to gain a better lifestyle, a more affordable lifestyle. And that's not just Utah. That's Utah, that's Boise, that's Vegas, that's Phoenix, that's Denver, that's Texas. So it's not just Utah, but those kind of tertiary cities that are more affordable than the coasts have a nice longer term tailwind to them that we can confidently lean into and say, yeah, aside from short term factors like rates, aside from short term factors like hotspots that blew up because of COVID, I think those longer term trends are something to lean into for Utah specifically. So certainly more bullish on Utah and Utah real estate and Utah's economy than I am for the 50 state average for sure. In terms of local real estate dynamics and in terms of what you guys might be looking at, boots on the ground, you guys have a better sense of it than I do. But when I look at just data, whether it be demographics, whether it be income, whether it be home prices in different regions, there are a few trends that I think are worth pointing out. I mentioned the COVID-19 hotspots, places like Florida, Texas, Arizona that attracted a lot of call it work from home transplants or the Great Resignation, where a lot of people just retired and moved to those spots. You're starting to see a reversal of some of those trends in those markets. So folks wanting to move back and be closer to home to where they left, or being forced to come back into the office, or realizing that their lifestyle was not as desirable as they thought it might be when they moved there. So you're starting to see some reversals in some of those hot spots, and that specifically for Utah might include places like Park City. It might include places like St. George that attracted that lifestyle on more of a short-term temporary basis. So I would be perhaps a little bit more cautious about those areas. I think Salt Lake City will be fine. I think it'll be more in line with the regional and state level trends. If you're looking for maybe potentially attractive or cheap areas that could have a nicer tailwind than the state at large, places like Heber Valley or Vernal out that way, east of Salt Lake City, those are potentially a little bit more attractive just because the incomes are rising in those areas when I look at the county level data relative to the home price. So when you have that ratio and when it looks attractive, getting ahead of that might be a place to look. Again, you guys know boots on the ground better than I do, living it, breathing it every day. But when I look at incomes, when I look at valuations and demographics, those areas east of the Salt Lake corridor potentially look a bit more attractive. North of the corridor also, but I think the terrain and land might be a little bit more attractive east rather than north. Not to put a knock on anybody who lives there, but and just in terms of relative valuations and just pure data, that's what I'm speaking to there.
One note on that as well. We just got the economic data for the whole state last week as well. Iron County is right there in that same mix of a lot of those eastern counties. Similar growth numbers on the real estate numbers, similar wage growth percentages as well. I know a lot of you are down in Iron County, have a lot of properties in Beaver County as well. Those two areas are much more similar to Heber Valley and some of those farther east valleys in that they didn't get all the COVID growth like Washington County, but Iron County is actually on a faster growth trajectory right now than Washington County is on a real estate standpoint. At least that's what the numbers say. So those of you that are looking in some of those southern Utah areas, maybe we like Iron Beaver County a little bit more than Washington County for the investment real estate portion. I was talking with a couple of people the other day, real estate home prices in Washington are actually starting to come down significantly quicker than those in Iron County and Beaver County as well.
Good observation and more relevant data than I can provide, Weston. So thank you for, for adding that color. Hopefully that loosely aligns. I don't know all the counties in Utah, admittedly, but I know the big ones. And
the fact you were able to mention Vernal of all places, like that's impressive. At this point, you're just showing off. I'm like, wow, that was ridiculous.
Well, you got Ogden, you got some of the other areas, North Farmington, I think, north of Salt Lake. So I've been around the corridor and some of those other areas, but I also admittedly like to study maps as well. So I haven't been to Vernal. I don't know what it's like, but I know it's a little bit more rural. But I have been to Heber, and I could see the growth for sure out there, noticeably. So some of those areas just kind of jump off the page to me, but.
Any other questions? Anything else we can dive into right now? Ryan, did you have more you wanted to go into on that point?
Just one other point. I was going to touch on the national picture as well. Nationally, I think 2025 is going to be the year that you revert back to a more benign or slower growth for real estate prices, more similar in line to their historical averages. I think the COVID run-up is all but over. And I say that because we pumped so much money into the economy, whether it be the government handing out checks to people or the Federal Reserve injecting liquidity. All that money had to find a home in one way or another. Some of it landed in real estate, some of it landed in stocks, some of it was spent, some of it landed in crypto, et cetera. But a lot of that injection has kind of run its course and run through. The inflation picture has cooled significantly. So I think that's kind of the overlying trend or overarching trend when you look nationally at real estate, is that I think it's going to fall more back into line to that annual growth of say 4 to 5% versus that double-digit growth that we saw spike because of COVID irregularities, if you will. I do think there is the potential for the supply side of the equation to expand ever so slightly. We're really in a frozen market, if you will, because the demand side is challenged by higher rates and affordability, and prices have run up. So they're challenged. They want, there are millennials and Gen Z who want to enter the market who can't, who are anxiously waiting on the sidelines. But there are also sellers waiting on the sidelines who don't want to give up those low mortgages and free and clear properties that they own. But I think you could see an uptick incrementally in the supply side, simply because we've gotten used to this environment, and the longer that we kind of get used to these prices, the more likely it is that some of those sellers are sitting on some nice gains, and they might say, hey, we're not going to see those super cheap rates again, but I want to move up to a bigger property or a more attractive property, and I'm willing to finally you'll pull the trigger on that versus the last couple of years where you see the numbers jump off the page and you don't want to sell your house. So if you see slower growth and you're sitting on some nice gains, maybe you pull the trigger more than you do before. I mentioned some of those irregular trends with return to office and travel being pretty peak demand, and some other areas like that might return to their longer term trends as well, and that can help the supply uptick as well. So I think that'll be good, even if supply does outpace demand. I simply think it'll be good just because it'll kind of thaw or unfreeze the market, which is just resulting in very, very low transactional volume. And that has been a headwind for local economies, for anyone tied to the real estate sector, whether it be construction workers, home builders, mortgage brokers, agents, et cetera, that kind of benefit from increased transactions. So, the prices might not run up the way that you've seen the last few years, but tangentially, I think you'll get a little bit of an uptick in volume and a little bit of an uptick in properties available for sale. So that's kind of my national level comment. I think that Utah is better positioned than the other 50 states. And then within Utah specifically, I pointed out a couple of things to be cognizant of, whether we be caution around COVID hotspots like St. George. But as a whole, I'd rather be in any of those markets in Utah than some of the places that are hurting for growth in the call it the South or the Midwest. But
Thank you, Ryan. I'll just throw a couple of quick comments on there. If there's any more questions, throw them at us. I think we're about wrapping up on time, right, Derek?
Yeah, you got a couple more minutes.
Okay. Any of you that have more questions, feel free to reach out to us. If you don't have contact, reach out to Derek. He can get you in touch with us. If you enjoyed this content, we do these economic updates quarterly. We actually have one coming up the 30th of this month. If you're interested in getting on and learning more in those economic updates, reach out to Derek. He can get you my contact information and I can get those to you. Like I said, they're quarterly. We try to just do bare bones, so there's no sales in it or anything. It's just talking through the economy and where we see things moving and where we see opportunities versus things that scare us. So if that's something you're interested in, reach out to us. We can get you on that list to get those webinars. They're once a quarter. They take about an hour. We'll have various different people that are giving their inputs. We'll have bond market specialists that'll get into interest rates, economic stuff. So if that's something you're interested in, that's something, it's nationwide. So if you have friends throughout the country, we do those for free. There's no cost to it, and you're welcome to join on any of those that you'd like, with no obligation. Again, thank you all for your time. If there's more questions, feel free to send them our way. I'm going to be on and off this call. I've got an appointment coming in a minute, but I'll be back on for the afternoon as well. So Derek, thank you. Thank you to your team. You guys are awesome. Thanks for the time.
Thank you, guys. One other note that I'd like to throw out there, just some people think it's a good thing, some think it's a bad thing. I just look at it as just additional data. So here locally, if you look, I mean, D.R. Horton's the nation's largest builder. If you look at the bet that they're putting in Southern Utah and the investment that they're making, it's pretty massive. So the level of data and stuff that they have to place these bets is ridiculous. The other one, so on the rental side, the nation's largest management company is Greystar, and they had recently bought a building here. And so now we have the nation's largest property manager and the nation's largest builder that are starting to invest in our community. That's not necessarily saying that's a good thing or a bad thing. People have their opinions, but the level of data, once again, it shows the confidence that they do have in our market here. So that's what I'll just add. Thanks again, Ryan and Weston. Like, I'm still impressed. I did expect you to go skinwalkers when you mentioned vernal, though, Ryan. So I am a little disappointed there. I fully expected that's where you're going to say.
I'm gonna need a definition of that.
Me and Weston will get you that information. So
okay.
Thanks again. I really appreciate you guys.
You got it. Thanks for having me on. Appreciate it.
Thank you, guys.
Alrighty.